$1.29 billion in record quarterly revenue. Yet ARM Holdings plc is quietly masking a massive profitability collapse. How can a business dominating the physical infrastructure of the artificial intelligence boom report plunging margins? Is Wall Street ignoring the fundamental truth hidden within the data? Total revenue surged 22% year over year to hit $1.29 billion, driven by data center royalties that more than doubled. Headlines scream about this acceleration as proof the firm is taking market share from legacy x86 architecture providers, like traditional Intel server processors. At first glance, a GAAP gross margin of 97.2% makes the business look invincible, meaning almost every incoming dollar skips direct manufacturing costs. Analysts focus purely on this elite gross profitability, assuming the company is a flawless profit engine. But to master this earnings report analysis, you must look past the gross margin illusion. The fundamental reality is more complex when we move down the income statement. Management proudly highlights an adjusted non-GAAP operating margin of 41.2%. The crowd loves this adjusted number because it paints a picture of extreme operational efficiency. However, the actual GAAP operating margin collapsed to 7.1%. Where did that profit go? It was absorbed by an astonishing $343 million in share-based compensation expense. That single line item eats up over 26% of total quarterly revenue. The firm is printing shares to retain top engineers, shifting the massive cost burden directly onto your equity through dilution. While reported GAAP net income hit $270 million, generating a diluted earnings per share of $0.25, this profitability was artificially boosted by a one-time gain. As an investor, you must weigh whether this heavy dilution is a necessary evil or a persistent drag on true shareholder value. To grasp why the business survives this margin compression, we must look at the cash entering the bank. Despite the decline in reported operating income, operating cash flow exploded by 172% year over year to $902 million. Why is this cash conversion completely decoupled from the bottom line? Because share-based compensation is a non-cash expense, meaning it does not drain liquidity from the corporate treasury. When you strip out these accounting adjustments, the enterprise generated an elite free cash flow margin of 51.6%. The company converted over half of its quarterly sales directly into liquid cash, a tremendous feat. This elite cash generation provides ARM Holdings with an immediate safety cushion of $3.05 billion in cash and cash equivalents. Add an additional $830 million in short-term investments, equating to $3.88 billion in total immediate liquidity. With zero traditional debt, the current ratio sits at a strong 5.25, meaning liquid assets easily cover short-term obligations 5 times over. They completely avoid expensive debt markets, while the federal funds rate sits elevated between 3.5 and 3.75%. This financial cushion allows the firm to absorb a 28% year-over-year surge in total operating expenses. But what exactly is management building with all that capital to secure their future market dominance? The company is aggressively pivoting from a capital-light intellectual property licenser into a direct manufacturer of physical hardware. Specifically, they are developing the new ARM AGI CPU platform for massive AI data centers. Management upgraded their forward revenue guidance, revealing the customer pipeline for this physical silicon exceeds $2 billion across 2 fiscal cycles. Furthermore, Q2 revenue guidance is firmly set at $1.38 billion, alongside Q2 earnings per share guidance of $0.47. Wall Street assumes this $2 billion hardware target is a guaranteed valuation catalyst, but building hardware introduces severe supply chain complexities that a licensing model simply never faces. To execute this pivot, the business must significantly ramp up physical infrastructure spending. Capital expenditures hit $197 million this quarter, signaling a highly capital-intensive operational era. This transition will structurally lower long-term gross margins from their 97.2% baseline, but vastly increases the revenue captured per chip. However, there is a serious catch to this market optimism, tied directly to how the company communicates its future product demand. Just as the firm undertakes this massive hardware transition, management ceased reporting remaining performance obligations. Remaining performance obligations serve as a critical indicator, representing the legally contracted backlog of future sales. At a time when US inflation hovers at 3.4% and the US dollar index sits at 99.6, losing this visibility removes a vital safety net. The crowd assumes this is merely a standard corporate reporting update. Removing these backlog metrics forces analysts to rely entirely on optimistic management commentary rather than contracted revenue data. Losing this financial visibility fundamentally increases the underlying execution risk for the entire business. But there is an even larger structural vulnerability lurking deep within the financial footnotes that almost everyone is ignoring. Deep within the balance sheet, total assets increased to $11.19 billion. Look closer and you will find 30% of total revenue, equating to $388 million, is tied directly to related party transactions. The company also carries $858 million in related party accounts receivable and contract assets. This acute customer concentration ties a massive portion of the firm's solvency to a specific client base, historically linked to regional overseas operations. While investors focus on AI infrastructure adoption, sudden regional market volatility could disrupt these collection cycles. If those related entities suddenly delay payments, the return on assets, which currently sits at a modest 2.47%, could rapidly deteriorate further. Once you grasp this dynamic, you will view financial reports in a new light, always verifying the core source of revenue. Let us return to our central analytical paradox. How does a company generating $1.29 billion in record quarterly revenue report such a dismal GAAP operating margin? The ultimate verdict is that Arm Holdings plc is executing an incredibly expensive strategic pivot. They are sacrificing short-term GAAP profitability, burning $343 million in share-based compensation to fund a leap into physical production silicon. The underlying cash flow proves the core business remains an absolute cash-generating machine. However, this analysis reveals a firm walking a dangerous financial tightrope. It is transforming into a capital-intensive hardware business exposed to severe concentration risks. While the $2 billion pipeline for the AGI CPU proves they are winning the physical infrastructure race, continuous stock dilution leaves a thin margin of safety. To win long-term, you must trust management's hardware gamble will scale fast enough to outpace their operating expenses. But now I want to hear your take. Does massive operating cash flow justify heavy shareholder dilution, or is this hardware pivot a trap? Let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.